all of us day in and day out work in IFRS, financial reporting. We work on Ind AS, we work on US GAAP, and we work on multiple facets of finance. And for the purpose of raising capital, for the purpose of basically raising money, for the purpose of changing money between entities, we have a lot of these financial instruments, and one of those important instruments are redeemable preference shares. Now, in form, as far as Indian GAAP is concerned, or the Companies Act is concerned, any kind of redeemable preference shares, okay, from an accounting perspective, was always treated as equity, right? So, we are going to figure out today that how a company's leverage ratio can be impacted due to implementation of IFRS or Ind AS from a ratio analysis perspective. Now, in form, all of us have learned that in the legal form, any kind of shares, whether it is redeemable preference shares, compulsorily convertible preference shares, optionally convertible redeemable preference shares, everything is in equity. But in substance, what is a redeemable preference share? In substance, redeemable preference share is very simple. It has a fixed coupon and it has got a fixed obligation, what is going to be basically paid on a future date. By virtue of this, you tell me in substance whether it is basically a debt or an equity, because I'm going to pay a fixed coupon, I'm going to pay a fixed obligation in future, okay, and the amount of redemption is also fixed. Now, when the liability is fixed, when the amount is fixed that is repayable in future, when the coupon is fixed, then logically, how can I say it is an equity? It is of course a debt, right? Now, the moment if I reclassify anything from a equity to basically debt, what is the implication? The implication is huge, because the debt equity ratio of that particular company is going to get adverse. Take an example of JSW Steel. JSW Steel issued redeemable preference shares, as a result of which their debt equity ratio got adverse further. They had an impact on the PBT, because when it comes to redeemable preference shares, when it is being disclosed as debt, the interest component or the fixed or the coupon component on that will go as a line item above the PBT, and in the erstwhile Indian GAAP, it used to go on the appropriation side. That is the biggest difference. Now, as I told you, the principle of substantial form, okay, says me very simply that if there is a fixed obligation to repay money and if there is a fixed coupon rate, then definitely yes, in case of JSW Steel also, it is a financial liability. Impact, equity will decrease, liability will increase, leading to increase in debt equity ratio. Under Indian GAAP, again, as I told you, dividends were being taken as an appropriation under below the PAT levels, and under Ind AS, dividends or coupon is going to go in the interest line as a finance cost. Okay, and the finance cost of the company is also going to increase, and the PBT is going to reduce.